Well, the big news this week came from the Reserve Bank of India. After more than 2 years, the RBI cut lending rates by 50 basis points. What prompted this move and what will it mean for you? Take a look.
Most of us have probably forgotten the last time loans became cheaper for us, and justifiably so. The Reserve Bank of India has been on a rate hiking spree since early 2010. But a slowing economy and high inflation levels finally pushed the RBI to cut lending rates by 50 basis points on the 17th of April. RBI has hiked lending rates 13 times since March 2010. In this space of 2 years, the repo rate went up 350 basis points, from 5% to 8.5%. This prompted banks to hike interest rates on your home and auto loans, making it significantly expensive for the borrowers. And this would have continued if the Indian economy hadn't been on the brink of another slowdown. Industrial manufacturing grew a meager 1.1% in January, while February's production data also fell below analyst expectations. This was largely due to a slump in demand and persistently high levels of inflation. With all the negative news surrounding us, the rate cut came as a huge sigh of relief. And prompted by the RBI's move, ICICI Bank has already cut its deposit rates by 25 basis points, and other lenders are expected to follow suit.
Rates will definitely fall, and we've always held the view that both sides of the balance sheet will fall. So you will see deposit rates falling and advance rates falling. We are not going to be any different from any other player in the market.
But keep in mind that the RBI has made it very clear that this is not the start of a slew of rate cuts. It is a temporary step to give growth the catalyst it needs and nothing more. So while your loans may get a little cheaper, it isn't here to stay.
Alright, let me bring in Dhirendra, the CEO of Value Research and our in-house mutual fund expert who joins us on the show every week. Dhirendra, welcome to Investors Guide as always. In reaction to that RBI rate cut, was this something you were expecting? 50 basis points was more than the market had expected. But do you think this was long overdue?
I think it was long overdue, and it was certainly a surprise. The market consensus was something different, and it was more than that. But it came with all kind of riders, and that is something which one should be, one should not expect this rate cut to be an accelerated rate cut, as we witnessed in 2000, that rates came down from 9% to 5% successively over the next 2.5 years. I don't think this is going to be a secular rate cut regime, because all kind of apprehension prevails. So this comes as a surprise. It's good for the equity market more than the bond, more than the fixed income funds or fixed income market perspective.
Any word of caution there for debt fund investors at this point?
Investors need to be aware of a few things. One is that liquid funds, the way they have been giving return over the past nearly 2 years now, that may not be sustainable. But I don't think those investors have any choice. There are many long-term fixed income investors. I think for them, they need to really change their track. They need to really consider the dynamic bond fund, the income fund,